Hello, and welcome to the FI Entrepreneur, Financial Planning for the Risk Taker. This podcast will show you how to achieve FI through entrepreneurial pursuits by developing a well-calibrated and thought-out plan for risk management so that you can maximize the rewards.
Hosted by certified financial planner, enrolled agent, and serial entrepreneur Ben Martinek, this is the FI Entrepreneur, Financial Planning for the Risk Taker.
The information presented in this podcast is for educational and entertainment purposes only. None of the content is presented as investment advice. Consult your financial professional before acting on any of the information presented in this show. Good morning, everyone. This is Ben Martinek, the FI Entrepreneur. You're joining us on the FI Entrepreneur Podcast, Financial Planning for the Risk Taker. And we've got an exciting show today, don't we, Deb? What are we going to be talking about?
I'm very excited because I'm going to learn a lot, so hopefully you will too. We're going to be talking about when an LLC should move to being taxed as an S-Corp.
Right. We've been talking about a lot of business entity items here in the last few podcasts. If you've been listening to those, if you haven't, be sure to go back a few podcasts as we've been going through this rather important decision of whether or not to establish yourself as a business entity and the hows and the whys to that. Now, as we've been saying in each of these podcasts, and we'll say again here today, ultimately, the business entity selection decision is one that's based on both tax parameters and legal parameters. In either sense, we are not giving official advice or recommendations to anybody. So this is for entertainment and educational purposes only, as our disclaimer. And we certainly are not attorneys. And so we will not and cannot speak to the legal parameters of these decisions, but we'll certainly talk about the tax parameters of this decision. So the question really is, so let's say you're starting a business or you have started a business and you've got some money coming in the door and some of that's coming home to stay with you. It's not just going right back out in other business expenses as you seek to grow. The question is there any smart money moves here in terms of how you choose to be taxed as a business entity? And Deb, do you know, are there any smart money moves to be made between what would be like a single member LLC, effectively a sole proprietorship in the eyes of the IRS, what's also known as a disregarded entity, versus, let's say, making the S election on Form 2553. Ooh, big stuff, very exciting. And now becoming, in the eyes of the IRS, to be treated like an S corporation. What would that do for somebody? You have any idea?
I have no idea. I feel like I need to go back and listen to our other podcast episodes that talk about this. And I'm really intrigued to find out what the answer is as you go through these different scenarios, because this is something that, so you may have gathered this in the podcast that you listened to so far with Ben and I am not so business minded. And when it comes to this technical stuff, like I just don't even think about it. And maybe that's where you are too. So I'm glad that there are opportunities for people like Ben to be able to share his expertise in the work that he's done with his clients and in our own businesses, to be able to direct you on what might be the best route for your situation. So I know nothing. I'm here to learn more.
All right. Well, fun stuff, folks. We're about to get into it. So if you were wanting to know whether or not you should establish yourself as an S-Corp, again, for the IRS to be, really, I should say, to be taxed like an S-Corp, well, let's get into it. A few considerations. Why would you do this? What's the difference between a sole proprietorship, ultimately a disregarded entity, versus an S-Corp? Well, if you recall, a disregarded entity in the eyes of the IRS, any profit, really, what's called net profit produced by that entity. So as a business, you bring in revenue and you have sales and transactions. And let's say it's $100,000 you brought in sales this year. Now, if you haven't been in business before, this may be news to you, but you certainly don't, at least for most people, don't bring that whole $100,000 home to you and it comes home to your pocket. You've got overhead and expenses, right?
If you are bringing that all home, give us a call. I'd like to talk to you.
No kidding, right? Let's have a conversation. So now we've got actually some clients who, they don't really have a whole lot of overhead. So whatever they make comes, right back to the personal bank account. Depending on your operation, that's probably, for most people, that's not going to happen. So you've got some business expenses. You have expenses that you're incurring for the pursuit or the production of that income. And thankfully, those expenses are deductible to you and you don't have to pay taxes on that money. So let's say you have, you produce $100,000 of sales. You've now got $30,000 of expenses as part of the cost to produce that income. And now you're left with $70,000. But let's say you want to leave some money behind in your business because you want to grow and you need some capital and you'd like to have a bit of a reserve. So you actually only bring $50,000 of the $70,000 home to your bank account. Now, you might think, oh, well, I only brought $50,000 home, so I only have to pay taxes on that. That's all that went and left from my business account into my personal checking account. But the IRS doesn't see it that way. You ultimately made $70,000. And so even if $20,000 is left behind in the business account, you still have to pay taxes on all of that money, the full $70,000, not just the $50,000 that comes over. And just as importantly, because this is earned income, you are the only person right now working as a sole proprietor. It's not passive income. You can't have a passive income sole proprietorship or single member LLC because you're the reason why the whole thing works, presumably. So all of it is subject to earnings, and all earned income, whether you're self-employed or employed, is subject to FICA taxes. What are FICA taxes? I actually should know the acronym FICA, F-I-C-A. I don't know that off the top of my head. I just know it as FICA taxes. I'm sure if I dug around a little bit, I could find this. It's ultimately the breakdown of Social Security and Medicare. So you have OASDI, Old Age and Social Disability Insurance. Is that what it stands for? OASDI? Boy, I'm not even sure, but that's ultimately your Social Security taxes. And then you have Medicare taxes, which ultimately go into the Medicare program, both of which primarily are used when you come into retirement, although both Medicare and Social Security can be utilized before retirement, especially in the event of a premature death of a bread earner or maybe a disability, or ultimately, really disability would probably be the next big likely use of Social Security outside of retirement. So these are your contributions. And when it comes to FICA taxes, there's two forms of the contribution there. There's the employer's share going into Social Security, and then there's the employee share going into Social Security. Now, you may not be particularly familiar with this, especially if you're employed, because this all just simply happens at the payroll level, and it never isn't a tax that you actually pay out of pocket. It's taken out before your money ever even gets to you, goes to the bank account. But you'll see it noted there on your pay stubs. And so as an employee, you only have to pay half of the share of this, and then your employer picks up the other half of the share. If you're self-employed, you get both shares. This is one of the disadvantages of being self-employed, that FICA tax fully comes onto you. You are both the employer and the employee. And so roughly what's a 7.25% tax on if you're just an employee turns into about a 15.5% tax if you're self-employed. And that's not, in the world of taxation, that's not a small level of taxation, 15%. And an increase in 7% taxes is certainly not a small increase in taxes. We get pretty excited around here if we can find a way to shave a couple percentages off here or there. So 7% certainly, one of those things that you can get excited about.
And that percentage, just so I'm hearing you correctly, that is applied to your net income, not your annual revenue, but your net income.
That's right. It would be what's called your net profit, technically, at least on the Schedule C in the IRS forms. So that's going to be the money that's left over after you've incurred those expenses. So going back to our example, that's the $70,000. So again, whether you bring that other $20,000 home or not, you're getting at least a 15% tax on that money because it's earnings. And then whatever the rest of your tax situation, whether or not you're married or single, head of household or the like, we also have your federal and state income taxes and those marginal rates being applied. Most commonly, those shake out to be somewhere between 10 to 20%. But if you're in the high income situation, marginal rates could easily be 30 to 40% between state and federal. So that also gets applied to that $20,000 that's left behind in the bank. So the issue is, with a single member LLC, one of the latest perks that we have had that comes into play with the Tax Cut and Jobs Act that was signed into law with President Trump is this new deduction known as the Qualified Business Income Deduction, QBI. And there are some nuances to this, and I'm going to spare you the details as to all those nuances. But by and large, for most people, you get a 20% tax deduction applied to that net business income. So I'm spent some time here talking about all the FICA taxes. You pick up 15% there. Well, you do. But at least currently, under present law, and it's a recent development in just the last few years, but you now get a 20% deduction applied to that same $70,000. And that's pretty powerful. And it's a bit of a game changer, especially as we move into the discussion of whether or not to choose taxed as an S-Corp. Because to change things around, so we were just discussing a sole proprietorship, disregarded entity, how that would be handled. If you are a corporation and now you are working for this corporation, and what I really should say is if you own a corporation, because you are, like as a sole proprietorship, you really are your business. With a corporation, you own a business, you own this entity by which you can also be employed by this entity. And so you can choose that entity structure and now have it be really this separate thing altogether from you. And as a matter of simplification, because the IRS isn't sure what to think of LLCs, they have kind of this chameleon effect. They can be seen in the eyes of the IRS as any number of things, even though an LLC isn't a corporation, technically speaking, at least in terms of legalese. It can elect to be taxed like a corporation, either a C corporation or an S corporation. And so you can make what's called this S election. I want to be taxed like an S Corp. And so why would you do that? How would that be advantageous from you from a tax perspective? Well, what you can do is, as an employee now of your corporation, you can pay yourself a salary. And you're an employee, just like anywhere else. You can give yourself a job. You can hire yourself and say, you're the man or the woman for the job. And here you go. Here's your offer letter, and let's sign you up. And the whole shebang, really not any different than if you were to be employed anywhere else. And so you get, a set salary. Now you have to have as a business the revenue, the recurring revenue, and the means to pay yourself a salary. This can be one of the challenges in being a business owner, is that you can have quite a bit of variable income, and 1 year is a good year, 1 year is the next year under a disregarded entity, and as an LLC, as a sole prop. That's not a big deal because it just is what it is. You don't have to pay yourself a salary. You might want to make a certain amount of income, but if the business just isn't having a good year, it's not having a good year. As an S Corp, if you're making this election, I suppose you could cut back on pay and lay people off or give yourself adjust your payroll. But we need to have a certain stability of income for this to work, because you're going to go on payroll. You're going to put yourself on payroll as an employee. And now both the employer and employee, which is still you, but it's in a more conventional format, is paying those FICA taxes. You might be like, well, okay, so isn't that what you're doing with a disregarded entity? What's really all that different? Here's the difference. In a S Corp, you get to decide how much of a salary you have. Now, salary has to fall within what's called reasonable compensation, and the IRS is a stickler about this. And we can talk about what reasonable compensation might mean. But you have to pay yourself reasonable comp. So you can't just be like, oh, I'm an employee to this corporation. They're only going to pay me 20 grand a year for my job. I just don't get paid very well. Not happening, folks. What do you think about that, Deb? Could that be an option?
Would that be an effort to skirt around some of their own taxation on their income? Is that what they do? Oh, I only get paid $20,000, so I don't have to pay as much in taxes. But that's not a reasonable income if you are the...
That is the angle, and we'll see this. I mean, I was working with a client who was a very successful attorney, had a very good, thriving law firm, predominantly owned and operated by her. I won't provide too much details here, but let's just say it was in six figures. She's making some good money. And her salary paid to her when we came across her with the S Corp was 40 grand a year. That's, what she was paying herself as an employee. And the IRS is going to look at that and say, reasonable compensation has to be what you'd have to pay someone else to do your job and your work. And, what attorney out there is going to take on a year's worth of legal work for 40 grand a year, folks? Do you know of anybody?
A comparable salary package, if you were in the open market, is what you would be looking at. That's a reasonable wage that the IRS would expect you to be paying yourself as a salary in an S Corp.
It does go a step further, because the IRS wants you to break it down potentially on all the various roles that you're fulfilling within the corporation. So you might be the one shebang, the only employee, but you're not probably just wearing one hat as that only employee. You're functioning a little bit like the CEO and the CFO and whatever else people do within a corporation. And so maybe you're chief marketing officer too, the CMO. So you're the executive officer, you're the financial officer, you're the marketing officer. You've got all these different hats. What would someone else require in pay in order to take on those different roles and responsibilities? You're probably not going to be able to pay them next to nothing, right? What do you think, Deb?
Well, if you are every member of the A team, a reasonable compensation would not be $40,000 a year.
No. And this is, the reason why the IRS is cracking down on this is there's plenty of accountants out there who would say, oh yeah, let's just put your payroll at $40,000 a year and we'll save you a whole bunch of money in taxes. And indeed you will. We'll get into how that would save you money in taxes. But the IRS is saying, no, thank you. That is not acceptable. No one is going to work and take this job for that kind of compensation. So now there is variation here, though. It depends on the line of work and what it is that you do. And, if you're a plumber or a carpenter or, someone who cleans out septic tanks for a living, probably going to be able to get away with paying a lower salary in those circumstances, perhaps, versus maybe, let's say you're an attorney or a dentist, right? You're probably not going to be able to pay a dentist just $50,000 a year. Again, I don't think anyone who's truly qualified as a dentist would accept that as their salary. And more so to the point here, the major source of tax savings is to be had on the Social Security side of this. You may not know the taxable wage base of Social Security maxes out at about $140,000. What does that mean? That means you don't have to continue to pay the Social Security side of the FICA tax after your net earnings exceed roughly $140,000. And the Social Security tax is the big portion of this 15% tax. So of the 15% that goes to be paid towards FICA taxes, roughly 12% is going to Social Security. The other 3%, 2.5%, is going to Medicare. Now, there is no income limit on the Medicare, so you will continue to see Medicare tax savings in excess of the taxable wage base of $140,000. But the big source of potential tax savings is really if we're talking about salary and income levels below $140,000 a year.
So if my income is $140,000 a year, I'll have that 12% Social Security tax withholding. But in excess of $140,000 a year, it just remains at that threshold of 140 or below.
Yeah, well, the Social Security tax won't be applied any further once it gets above $140,000. The only tax that now is applied is the Medicare tax. Where we would see significant savings is if we could shave off some of that Social Security tax in that 12% tax. But that's only going to happen if your reasonable compensation is below $140,000. So if you're in a situation, let's say where reasonable compensation puts you squarely at $150,000, there may be still room or value for you to be taking the S election. The value is going to be largely minimized because the tax savings has largely been reduced or removed, because now the only tax that we're really saving is the Medicare tax, which is roughly 2.5% between the employer and employee. So now, if you make, let's say, $500,000 a year, you pay yourself a reasonable salary of $150,000. And when I mean you make 500, like your net, what you're able to take home from the business is 500,000. And now we're able to save 2.5% on $350,000. So you pay yourself a salary of $150K, and you have now $350,000 that's not subject to that 2.5%. Well, that starts to add up. That's $7,500 or better, 10 grand in tax savings. So going through the rigmarole of having payroll and having this separate corporate entity that you have to file a tax form for, what's called a Form 1120S, can start to pay for itself because we don't have to pay quite as much in Medicare taxes. Now, it is worth noting as part of this, if you do take the S-Corp election and then you do pay yourself a lower salary, we designate only a lower salary if it's not completely all of your net profit from the business. The other ramification to this is we are only not putting as much towards Social Security. So what you will receive in Social Security benefits later down the road when you retire will not be as large, because what you've paid into the program is maybe only $70,000 a year when you, in fact, were making, let's say, $150,000 a year. Now, to each their own. I don't necessarily see that as a huge loss, because hopefully we can find other better ways to manage the money and make money off of that rather than getting it tied up with Social Security. But Social Security, for most people, is a pretty big source of retirement income. And there are actually some pretty good perks to that whole program. So the minimization of those benefits is something to keep in mind and be aware of as part of your long-term planning. So what happens to the other portion? So we were talking previously, we have $100,000 of income, $30,000 of expenses, let's say $70,000 of net profit. You've decided that you want to do the S-Corp election. You're going to start paying yourself $50,000 a year, and then we'll leave that $20,000 a year behind in the business. What happens to that $20,000 a year? It is not subject to FICA taxes, as we've been saying, so there will be a tax savings there. Now, you do pick up payroll cost. You have to run payroll on yourself. There are fairly inexpensive options for this, but you're still looking at probably $500 to maybe as much as $1,000 a year to have someone run your payroll. So that's an expense that you're picking up. And then you do have an additional tax filing form, an 1120S, that you are picking up. And usually, this tends to be the threshold in which somebody wants to start hiring out a professional to do this. They don't want to do their own 1120S, which I think is probably recommended. They're a little trickier. They're not crazy trickier than a Schedule C, but there is trickierness to it. And I would recommend that you get professional help. But to get that professional help, now you're going to incur another filing fee. And this is just going to depend on who you're working with, but you could easily spend $500 to $1,000 or more in filing fees just to do that S-Corp filing. And that's in addition and beyond now or above from what your individual filing is. That's not all encompassing where you get everything done. Part of that, this is just going to be additional overhead specific to the 1120S. So there are costs to making this S election. The full cost varies, but on probably the conservative side, you're looking at probably at least $1,000 more out of pocket to do this. So you obviously need to save at least $1,000 in tax savings. The other thing to take in mind here with this election that isn't often considered, even amongst tax professionals, just because they're stuck in their ways, is the qualified business income deduction. Where that gets applied varies now, depending on whether or not you're a single member LLC, sole proprietorship, versus the S-Corp. If you're in that former, the single member LLC, you get that 20% deduction basically to the net profit. So with our example, it would be 20% applied to 70 grand. If you are now an S-Corp, that 20% only gets applied to the money that comes over in the form of business income on your K-1. What is designated as a salary does not get the 20% qualified business income deduction. And that 20% is pretty substantial. And so in prior years, prior to the Tax Cut and Jobs Act, it was not an uncommon recommendation that if your business made, let's say, $100,000 net profit, oh, you should think about becoming an S-Corp. This is going to start saving you money. And with no consideration for the qualified business income deduction, that would be true because we have these FICA tax savings, especially if we are able to pay let's say a salary of, $50,000 on yourself and the other $50,000 comes over as a distribution. But now with the loss of that qualified business income deduction, by becoming an S-Corp, at least specific to the salary, it's not completely lost, it's just to the salary component. It really depends on how large of a salary you have to pay yourself to see whether or not this is still advantageous. If you're in a circumstance where, let's say, you make pretty good income as a business, but your reasonable comp is pretty minor, maybe you can get away with paying yourself just $40,000 or $50,000, and so potentially there's a pretty big FICA tax savings. Now, again, there's a loss of Social Security benefits further down the road, so don't forget about that. But you're getting some FICA tax savings, and the distribution of this is still mostly available to the qualified business income deduction, which is a 20% deduction. You're only really losing QBI on the salary. Becoming an S-Corp could really become advantageous. You could save quite a bit of money as long as you're comfortable with the reduction in Social Security benefits. It's a tricky decision. You really, quite frankly, I feel you have to have an analysis done, have someone get into your situation. The other thing that makes this trickier is the qualified business income deduction. It's not based on just your business income. As suggestive as that term might mean, it's actually really based on your household income because that QBI starts to phase out once your household, not business, household income exceeds about 300,000 taxable earnings. So if you're employed, working with someone, or living married to someone else who makes a pretty good living, and maybe your business is fairly modest, but their earnings is pretty substantial, QBI may or may not be present in your situation regardless. And so the loss of QBI may not be all that big of a deal. But the short of it, just to try to keep this all nice and sweet and fun, is the choosing to take that S election can certainly be advantageous. As to how advantageous it is just going to be dependent on your very specific situation. And the really big factor here is what's reasonable compensation in your scenario. If you can't really do much, if the change, let's say your net take-home pay is $70,000 from the business, and what you would need to pay someone else in order to do your work is $70,000. Well, becoming an S-Corp is not a good idea, right? Don't do that because you're going to lose QBI altogether on that $70,000, which is a 20% tax deduction. And you'll have the additional headache and hassle of filing an Form 1120S and payroll. And maybe there's some nice perks to the idea of you being employed by your own corporation and you're an employee and you've reverted back and have some stability to your paychecks. This can be a nice way to kind of streamline your cash flow on the personal side of things. It wouldn't make any sense for you to go and make that S election. I wouldn't advise on that at all. So reasonable compensation is a big part of this. Anyhow, I know I've gone on for a long time. Hopefully you're still with us here, audience. I hope you don't mind these long discussions on my part. It's like a soliloquy of sorts. But what do you think, Deb? Did that make some sense to you?
It did. I feel a lot more informed now than I was at the beginning of the episode. But I do have to share something before we close out. And maybe this is in completely the wrong direction, but I have to make an reference here. All I could visualize when you were talking about the S-Corp and hiring oneself for the job being done is Jim interviewing Dwight to be the assistant to the regional manager, and how Dwight was the only one qualified for it and didn't even realize he was going through the job interview process. So I don't know if that's quite on the same wavelength as an S-Corp, but that was the visual I had in my mind when you were discussing hiring yourself as part of this corporation, because there is the need for you to be an employee whenever you go this route, but usually don't interview yourself for your own position.
Probably not. I don't know. Can I work with you? I'm not sure. It's like an interior struggle or fight. So it's really the right guy or the gal for the job, right? No, it's kind of fun. But well, I think the only last consideration we'll have on this is we've pretty much well discussed the tax considerations. Really, the issue is as well, if you're going to go and become an S-Corp, one is be wary of any accountant that's just going to tell you, oh, you should become an S-Corp. QBI is a big new consideration. I know of plenty of tax advisors who are still just out of, what's the term for this, out of habit, suggesting becoming an S-Corp around $100,000 of income. That certainly is not current with present tax law. If they are suggesting that, you need to ask them to talk to you about QBI as well and what that might mean, because that is just as big of a consideration now as the potential FICA tax savings, because there is a loss of that QBI deduction, or at least there's potentially that loss. So, but that's the tax concern with an S-Corp. What about if we're talking about maybe as an LLC electing to be treated like an S-Corp? Why not maybe just become an S-Corp? Would it be better to be an S-Corp versus an LLC? This is certainly a more nuanced conversation, but that decision largely is based on whether or not you want any outside investors in your business. Generally speaking, investors, other people who become shareholders to your company, and very, very specifically shareholders, because that's what you have when you have co-owners within a corporation. You have shareholders. They want the corporation status, mostly because it's just a very established and defined business practice, and it's just a known animal. As I've shared in other episodes, an LLC and being a member of an LLC it's the new kid on the block, and we're not quite sure what to make of it. So if you're looking to raise capital within your business, simply becoming a corporation, whether it's a C or S corporation, can just simply make the most sense. But if it's just a mom and pop shop and it's just you or a few other limited partners in the deal, people who are also collaborating with you, the LLC arrangement can certainly be just fine. And there's no loss of both legal or tax savings by and large. Certainly can speak more to the tax side of this. You'll have to consult with an attorney to talk about any legal differences between a limited liability company and a corporation. But in my understanding of it, for whatever it's worth, it seems to be pretty uniform between those two, although that attorney can give you awareness of the distinction. But that's what we have to share today, folks, on that S-Corp. Hopefully that answered any questions that might be out there. I know we've got some people who have just said in their burning heart, wanting to know, should I make this S election? Gosh, it's exciting stuff, isn't it, folks? This is what I get up every morning, talk about, get into.
So long as there's a cup of coffee.
Yes. Yeah. Well, I actually don't mind. I do enjoy talking about this, but there are some days in my life I'm like, what? This is not what I thought I was going to do when I was driving truck and being a philosopher. But here we are.
We are.
What life turns into, folks. So we'll talk about some of the other fun aspects of entrepreneurship here in future episodes. I think we're putting a wrap on the whole entity selection piece for now. So hope you found this enjoyable and valuable. Please reach out if we can be any help to you, and stay tuned for future episodes.
Thanks for joining us today, folks.
Thanks for listening. I hope you've had as much fun as we did. If you'd like to learn more about any of the subjects we spoke about, please visit our website for show notes, links, and more. Hit like, subscribe, or whatever button you've got in front of you to show some love. Remember, the information presented in this podcast is for educational and entertainment purposes only.
Remember what Teddy Roosevelt said about the person who strives greatly. If he fails, at least he fails while daring greatly, so that his place shall never be with those cold and timid souls who neither know victory nor defeat. Until next time, keep striving.
Thanks again, and be well.